Let's talk about exactly what Mr. Carney said. Was there anything surprising to you in this?
Not really, but thanks for reminding all viewers I've got it horribly wrong this year. I appreciate that.
I actually thought it was sort of subtle about that.
Yeah, I thought you were really subtle. Just destroyed me there.
Fair, Steve Major's gotten it really right.
Yeah,
so
thanks. Yeah, he's going to do well and I'm not. Thanks for telling. No, but what was the mistake we made? We made the mistake that we underestimated the power of this idea that the Bank of England would raise rates. We weren't expecting to raise rates, and we weren't expecting sterling to trade on interest rates. We thought this is a political and structural currency, one of the biggest current account deficits in the world, a huge political problem with Brexit, and sterling's gone, let's ignore that, we'll concentrate on the Bank of England. And that's propelled sterling up to the 130s, and we've seen it looks largely priced in now that there's a November rate hike, and therefore sterling will go up. But next year, back to politics, back to structure, and sterling back down again to 126.
Well, exactly my question. Okay, you basically pricing in we're going to have one rise here, okay, after a 10-year period of no rises. Is it one and done, or might there be more coming next year if there's further inflation?
I think the expression is to and through, basically. So basically we've got another one next year as well. The Bank of England seem obsessed with this Phillips curve, that the low unemployment rate is going to cause wages to rise, blah-de-blah, and they want to raise rates. In my eyes, not the best thing in the world, but it's propelling sterling upwards. But it's really about Brexit and politics and the current account deficit that will really cause the underlying move in sterling and for it to drift lower again.
And just to sort of point out what you were talking about, if you come inside the Bloomberg, you can see how economists have re-rated what they're expecting from the Bank of England. So the white line here is where we are right now. That's the benchmark rate. This green line here is now where the market expects a rate hike to come in November, but then not another one until March of 2019. The blue line is where we were just in September. So it shows that flip in market expectations. But my question, Steve, is that if you have a one and done, and Carney says it's one and done, what does that actually do?
What they have to do is engineer the expectation of at least one, maybe several. And so it's like trying to influence the expectations. And in many ways, they can get the impact of a potential hike through sterling. And David will talk about this. If they can get sterling to go up, if they can put a floor under sterling, then it actually does some of the tightening for them. And now, most of the inflation that we see, and you probably have noticed they had a 3% print come through, most of that is what economists would call transitory. So it's to do with the currency. So if they can eliminate some of the inflation pressure from the currency without hiking rates, that sounds quite clever. So they're on a bit of dodgy ground because they're trying to make the markets think they're going to hike. Yes, they're going to hike, but are they going to follow through with 2 or 3 hikes? So it could well be one and done or 2 and through, as David said, but it's the expectation that matters. So they're trying to manipulate the forwards and the expectations.